Hello and welcome to this month's webinar. The date may get you wrong. It's actually October 19th, 2022, but we're still doing the quarter 3, 2022 market and economic update. Today, our presenters will be Paolo LaPietra and Ryan Boucher. And I just want to thank you for taking time out of your day to be part of today's webinar. I think it's timely, especially with everything going on in the markets. As you know, this is when patience and fortitude will benefit us. And if we don't have any knee-jerk reactions, not us, but investors in general, they should weather this storm and the market will turn around. Before we know it, all of a sudden, we'll have more green arrows than red arrows. Without any further ado, I'd like to hand off the seminar to both Ryan and Paolo to get started. I hope you enjoy today's update. We're going to talk about the third quarter market overview, our economic outlook, reasons to be optimistic, tactical portfolio updates, how to take advantage of planning opportunities. Ryan and Paolo, take it away.
All right, thank you. So getting things started, looking a little bit into the market therapy right now, and you got the bull market asking, is everyone, or the therapist asking, is everyone out to get you? No, just the Fed. And that's really what it feels like so far this year. And really when we see market fluctuations and high volatility within the market, it is really driven by the Fed thus far. And so we're going to get into a little bit about just the Fed's impact right now, how corporate earnings are looking, and dig a little bit deeper as to kind of the outlook from here moving forward and where we could see some volatility and how we're trying to make some tactical changes within the portfolio to, adjust to this environment that, again, is really reliant on what the Fed is planning to do. So if we just look at the recap from the last quarter, not a lot of good to be seen within quarter 3 outside of small cap equities. Most of the major indices were down for the quarter, and frankly for the year, outside of some commodity and alternatives, which we've had exposure to over the last year and a half, it's been a challenging market environment, not only for equities, but as we've talked a lot about the bond market and fluctuations that we have never seen in a given calendar year like we have so far for U.S. bonds. So we'll talk a little bit about that. And obviously not only the bull market in stocks being affected by the Fed, but the lengthy bull market we had in bonds being affected as well. And so just a little bit high level, looking at our tactical allocations right now. And we're going to talk a little bit about this later in the presentation, but continue to be overweight U.S. equities. We find U.S. equities versus international right now place to be, given all the challenges, not only in emerging markets but developed markets internationally. Not really a place that we've been invested or looking to get invested. Continue to have a technology overweight. Once this market bottoms, that's going to be a real driver in the not only economy but also the markets. Some of our tactical allocation, we sent a letter out earlier this week, and we'll talk about later in the presentation as well, is dividend growth companies. And these are not just companies looking for high yield, but what we're really looking for are strong companies with strong balance sheets, strong earnings, strong cash flow, and ones that we continue to see growing over the coming 6 to 12 to 24 months. And then some more defensive pieces of the portfolio, healthcare and consumer staples, we continue to be a little overweight. So let's get into a little bit more of the overall presentation. We'll talk a little bit about just valuations, earnings, and just overall corporate sentiment at the moment, because frankly, the conversation really has been centered around the Fed, inflation, but what does corporate America look like right now, and what do valuations look like? So this is a great graph. I like looking at the last 25 years here, and this shows just the forward PE ratio, so the price to earnings ratio. And it's not meant to be, the only piece of data or, data point to come up with valuations for stocks, but it's a great, great starting point to look at what stocks are trading for and how do earnings look. And so, and I pointed out in this graph, I wanted to show you that, during the tech crash in 2000, valuations were very elevated. The stock market was trading over 22 times forward earnings, which on the flip side, during the global financial crisis, stocks were actually trading within their, historical average. So it's not all about forward earnings and this price to earnings ratio. But when you look at stocks today and where they were trading at, a year ago at the end of 2021, we were getting to that point of where we were during the tech bubble of the 2000s. And now as we've, had this recent sell-off, we're much more in line and even under that last 25-year historical average. So from a fundamental standpoint, that's a good thing. How does that differ from the global financial crisis, which, is not that far off from what those numbers are? Well, during that time, there was some, deep-seated underlying issues with the economy that, frankly, we're not seeing today. So, on a high level, fundamental basis, stocks are much better priced today than they have been in quite some time. Now, when we think about the PE ratio, there's two elements of it, right? Price, which price has been coming down this year, but also earnings. And so far, earnings season, the last week or so, earnings have been positive, right? We've been meeting expectations. And I won't get into every little piece of this graph. So this goes back only about a year and a half. The top line shows expectations for 2023. The bottom line shows expectations for 2022. But what's really important to just point out as we kind of look at fundamentals and look to as we head into 2023 is that, earnings expectations really peaked back in April and June of this year. Since then, expectations have been coming down. So, it's still good that we are meeting expectations, but, honestly, those earnings expectations have come down quite a bit. And so when we look at forward price to earnings today, if earnings expectations drop even more heading into next year, that is going to throw that ratio off a little bit. And if that, denominator starts dwindling a little bit, it's going to raise that PE ratio up a little bit as well. And so, that's something we are continuing to watch and to stay in line of, typical growth and where stocks are trading today. We need another 8% growth in earnings heading into 2023. And again, can we get that? Absolutely. But if we do start seeing some slowdowns because of what the Fed's doing, everything in their power to slow down earnings growth, that's certainly an area that we want to continue to watch and see what the expectations, how they change heading into the end of this year and early 2023. When we look at CEO confidence and, frankly, CEO confidence is more of a feeling. It's not, necessarily driven by data or, what's going on in the market. It's really, the feelings and sentiment of CEOs. We are seeing a slowdown right now in terms of their confidence. And when you see historically over the last 50 or so years, typically those slowdowns in the lowering of CEO confidence has coincided with recessions. Maybe that's not the worst thing ever because, as we're looking for some glimmer of hope from the Fed, we need some sort of, pullback, or we need some sort of pressure on overall growth of inflation and what we're seeing. So, without taking into account, hopefully not many jobs are lost, or it's something that could be, shallow if we do see a recession, we could be, frankly, we could be in the middle of one right now. And many times we don't know a recession is happening until we're kind of through parts of it. And so when you look at CEO confidence, again, right now, it is dropping and is low. Again, something we want to, continue to watch. And, the good thing right now could be that, hey, they may be becoming a little bit more conservative with their outlook, which again, isn't a bad thing as, we head into the end of this year. Latest piece of data, just in terms of job openings. I mean, that's been one of the stories that we've been focusing on, right? We've had a ton of job openings over the last year that frankly, we can't even fill. Just recently, we're starting to see kind of a pullback in some of those job openings. Again, it's not necessarily indicative of a typical recession. Usually you would see, jobs being cut versus just job openings slowing down. But seeing a slowdown there, maybe goes to show that some of what the Fed is doing is starting to creep into our economy and, for better or for worse, maybe starting to work. So again, not a, typically a strong economic indicator here, but in terms of what we're dealing with the Fed and the impact the Fed has been having, maybe this is showing some signs of a, bit of a slowdown in terms of what the corporate economic strength is right now. And so when we just kind of look at valuations this earnings season and overall corporate sentiment, right now valuations have reached historically normal levels for that price to earnings ratio. As we showed, it's not everything. The tech crash was much different than the global financial crisis, but stronger fundamentals typically can be good thing for investors. And as we look forward, earnings contract, fundamentals may not look as strong. So that's something we'll definitely be looking at into the end of the year. Earnings estimates, just talking about it, they have come down as of late from what they were at the beginning of the year. But again, we're still meeting expectations right now, which is a good thing. We're seeing that CEO confidence is low, and we're starting to see a little bit of a slowdown in number of job openings. So, those are some of the challenges we're facing right now. But again, it's not all bad. There's a lot of reasons, especially at these levels, to have optimism within the markets. So if we go to the first slide, time is on our side. And this shows you the average cumulative return of a 1 year, 3 year, and 5 year basis over the last almost 100 years after we've seen a 10% market decline, a 20% market decline, and then a 30% market decline. We've hit about a 25% earlier this week before we had a little bit of strength in the markets. So if you kind of look between the 20% and 30% decline, if you're a long-term investor, right now is not a bad time to be invested. I know it doesn't feel good right now, but certainly now is not the time to panic within the portfolios. And Paulo will touch upon this a little bit later in the presentation. If we look at corporate insiders, this shows, folks at the executive level, and this is for companies within the NASDAQ, actually. You're starting to see more folks starting to buy. It's at a very, very high level. Again, this isn't everything, right? There can be some, missteps in corporate buying, corporate insiders buying, but I think it's a good metric to show confidence of some of these high level executives that, hey, valuations are pretty solid right now. This is a good time to start buying our own stock. Again, that a lot of times can be a real positive sign. So I like seeing that. We're talking a lot about inflation in the Fed, and we're starting to see supply chain stress not only slowing down, but getting to pre-pandemic levels. The supply chain has been a huge issue when it comes to inflation. And so seeing this slow down and get to those pre-pandemic levels is a good thing in the overall inflationary story. And even though we haven't had great readings the last 2 months, we are starting to see, maybe a peak or, hopefully a potential rollover coming in the, the near future. Which leads us to this graph. Is inflation peaking? Is it rolling over? And when you see on the right side, I mean, there is indication that, we are coming to a peak. This is needed for us to get a market rebound because, the market is not going to start coming back until the Fed stops their rate tightening and the Fed stops tightening this cycle. And we are really, they're determined to slow down inflation. And if we can just get some of these, levels back to a normal, typical range, that's going to be a positive for the markets. And I do think that we are, again, feeling some of that pressure, and we're seeing it in the data. All things considered, it does feel like we are, starting to peak and or, begin to roll over. And lastly, consumer sentiment indicator. When consumer sentiment is bad, it does typically fall in line with, bear markets, recessions. But when consumer sentiment bottoms out, and if you look over to the right-hand side, we did, bottom out probably in, July or August of this year. We're seeing a little bit of a recovery. Historically, when consumer sentiment does bottom out, the next 12-month returns have averaged just about 25% return. Again, this isn't everything, but when you lump it with all the other data points and measures that we're looking at, it doesn't feel good now. It doesn't mean we couldn't have some continued volatility in the short term. But if you have a long-term outlook, right now, it's not a bad place to be within the stock market if you're a long-term investor. So to recap, historically, now is really a great time to be invested if time is on your side. We are starting to see a peak and or slowing down of a lot of inflation metrics. That's a good thing. We need that to help the Fed get us back on track from a stock market perspective. Historically, we don't know a recession is happening until after the fact, but a lot of recessionary factors could start helping the Fed reverse course. In the market, frankly, it's not going to improve until the Fed does stop their tightening cycle. And then, when consumer sentiment does bottom out, future returns in the next 12 months have been very, very positive for investors. So these are things we're looking at. This is what gives us optimism for the future. Again, this isn't calling any sort of market bottom, but there is a lot to be optimistic about if you're invested in stocks. So with that, I'm going to turn it over to Paulo.
Thanks, Ryan. So for the next few slides, I'll be discussing the tactical moves that we've made in the portfolios. The first I'll be discussing is our underweighting on bonds going back to last year and the use of alternatives. As we saw an uptick in inflation in the second half of 2021, we knew the Fed needed to begin raising rates to help cool off the economy. The issue is inflation and rising rates are just simply not a favorable environment for bonds. So we began replacing bonds with alternatives, specifically defined outcome ETFs. Defined outcome ETFs, which we could see here with the ticker PJAN highlighted in light blue, give us exposure to the S&P 500, but cap the amount we could achieve on the upside and buffer the amount that we could lose on the downside. And they work on a yearly basis. So this specific holding, PJAN, gave us 9% on the upside to the S&P 500 with 15% downside protection. And if we look at the graph here, that shows us year-to-date performance on PJAN in light blue down 9.92%, Barclays Aggregate Bond Index in purple down 16.85%, and the S&P 500 down 22.73%. The defined outcomes did exactly what we needed them to do, giving us an alternative to bonds while limiting the volatility of the stock market. One of the few positive aspects of the Fed aggressively raising rates at a rapid pace is yields are becoming much more attractive. Since we've used defined outcomes in the portfolio, we have the strategic opportunity of unwinding these positions that have outperformed the U.S. Aggregate Bond Index in the tune of 7%, like we saw in the last graph with PJAN, and start getting back into bonds. And if we look here, this chart shows us that there's a strong correlation between the U.S. Aggregate Bond Index yield to maturity and the 5-year total return percentage over the last 40 years. The AG's current yield to maturity is a little bit less than 5%, which data suggests that we can expect a 5% annualized rate of return over the next 5 years. It truly is difficult to point out where the Fed will stop raising rates, but with these yields and potential annualized returns that we've seen from a historical basis, bonds are absolutely becoming more attractive again, and we're going to look to capitalize about that. With yields being low over the last few years, with the challenges with rising rates and inflation, and investors have moved away from that traditional 60% stock and 40% bond portfolio. But as we saw with the last slide, yields becoming much more attractive, it raises the question if the traditional 60-40 is back in style. Here we could see yearly returns for the traditional 60-40 portfolio going all the way back to 1988. And what I'd like to point out is a consistent bounce back in returns after a negative year, as shown with that orange arrow, with the exception of 2001 and 2002. This just furthers our conviction of offloading these alternatives over the upcoming months and continuing to re-enter the bond market. On our equity side of the portfolio, we continue to be pro-US stocks and have been only US stocks going back to 2019. We could see the benefit of that here with the S&P 500 highlighted in purple, up 47%, compared to developed international highlighted in orange, down 2%, and emerging markets highlighted in blue, down 8%. At some point, we'll probably re-enter the international sector, but with the energy crisis in Europe, the COVID zero policy in China, and the strong US dollar, we don't find the immediate environment favorable for either developed or international emerging markets. One of the byproducts of the Fed raising rates at a more aggressive pace compared to the rest of the world is a strong US dollar. This graph shows us how the S&P 500 performs against the MSCI EFA during periods of dollar strength and dollar weakness going back to 1975. The periods of dollar strength are highlighted in gray and dollar weakness in white. And at the top of the chart, we can see the differences in returns. In the 3 periods of dollar strengthening, the S&P 500 has outperformed the MSCI EFA, including our current environment. If you look at the right of the chart, this is showing how the dollar is continuing to strengthen in 2022, only adding to the thesis that the US equity market is poised for stronger returns compared to international. With the challenges of higher interest rates for stocks, we've added mid-cap value position to the portfolio, and that position is REGL. Valuations, as Ryan pointed out, can be an important characteristic to look at a high interest rate environment because investors aren't willing to pay more for growth type companies when they can earn an attractive risk-free interest rate through US Treasuries. If we look to the left, we could see that mid caps are trading well below their 20-year average PE ratio, which is just a common way of looking at valuations. On the right, on top of being attractive from a valuation standpoint, mid-cap companies also have more domestic-based revenue exposure, which is important with the impacts of a strong dollar, as we saw in that slide before. And we targeted REGL specifically because this fund only holds companies that have consistently grown their dividends over the last 15 years. So we're getting exposure to sound, quality companies that should do well in this challenging environment. One of the most common questions I've been getting while talking with clients over the last few months is, what can I be doing now to take advantage of this volatility? The next few slides are some best practices that we've been sharing with our clients. I'm sure the majority of you listening have heard Steve on the radio at some point say this is a good buying opportunity, and history absolutely supports the statement. This graph looks at every S&P 500 decline of 20% or more since 1950. And with the following 1-year return and 3-year return annualized. If we look at the bottom right, we'll see the average peak to trough, meaning the top of the market to the bottom, is negative 34%, with the average 1-year recovery from the bottom being 39%, and the average 3-year annualized being 15.5%. It's impossible to say where the bottom is, whether we saw it last week or we're going to see the next few weeks or even quarter. But what's important is if you have money on the sidelines, this is an opportunistic time to invest at these levels, as historical data has shown us. Roth conversions are another great way of taking advantage of this volatility. There's so many advantages to having a Roth IRA in general. All growth is tax-free. You pay no taxes on qualified distributions, and you never have to take a required minimum distribution, unlike traditional IRAs. Also, Roth assets can be passed down to your heirs tax-free. But this graph does a great job of showing why Roth conversions are advantageous during volatility. If we look to the left, this is showing an IRA balance of 100,000, which drops down to 75,000 during a market correction. And if you were to convert that IRA into a Roth IRA, you would still be at that 75,000 amount, less any federal and any applicable state income taxes. But when that market recovers, that full recovery, illustrated here as at 25,000, will avoid taxation. Now, there's things to be aware of, such as taxes that needed to be paid during the conversion, and making sure those taxes don't push you into the next tax bracket. And these are all things that your advisor or your tax professional can help navigate for you. One last thing is tax loss harvesting. Tax loss harvesting is a great way of taking advantage of market volatility. It allows you to sell investments that are down, replace them with something reasonably similar, and harvest those losses to either offset realized gains for the year or use up to $3,000 to offset ordinary income on federal income taxes and carry forward excess for future years. Now, the wash-out rule is something to be aware of when tax loss harvesting within the portfolio. This rule will disallow any losses if you were to buy the same investment within 30 days before or after the day you sold that investment for a loss. So if you plan on doing any tax loss harvesting within an account you manage yourself, highly recommend discussing with an advisor or a tax professional first. And I'll pass it back to Steve for some closing remarks.
Thank you, Ryan and Paulo. I think you gave some great information. Folks, Paulo and Ryan really are instrumental in leading the investment team, and they've worked on this in a big way. And as you hear me say often, right now there's a lot of fear on where the market's headed. We know that the Fed a year ago was a little late coming to this party, as I like to say. They really they weren't proactive raising interest rates when we knew inflation was there. They didn't know inflation was there. They called it transitory and temporary. But you and I and anybody that we know understood that we were paying more at the gas pump, in the grocery store, more on heating bills. We knew inflation was real. So now we know that inflation is here. In June, it was as high as 9.1. It's come down a little bit. The last reading was 8.3. We need for it to come down a whole lot more than that. So the Fed it's almost like they're being a schoolyard bully and talking tough. They want you to believe that they are on top of this. They will do everything they can in order to make sure inflation comes under control. And with that being said, as Ryan mentioned, they will be raising interest rates as much as they need to and as often as they need to in order to accomplish that mission. But as you hear me say often, inflation is a moving target. That means that inflation, at any time, we could get a report which is favorable. And the Fed may have to change their tough talk and maybe be a little softer. And there's no reason why, and we don't know if we're in a recession. The old definition of a recession was 2 quarters of negative GDP growth, which we actually had quarter 1, quarter 2 of 2022 were negative. So the old definition, we were in a recession. Now with NABER, they will not let us know if we're in a recession until they really take a good hard look at it. And so far, we're not sure if we're in a recession or not, but whether we are or not, it feels like we are because of the high prices we're paying. Now, the good news is there's a lot of jobs out there. Anybody who wants a job can have a job. We have 10 million job openings, and we have a lot of people on the sidelines, unemployment, that could grab a job if they want. Companies are paying their workers more, better compensation packages, flexible. And the reason why they're doing all of that is because they need to. The global pandemic that we lived through over the last 2.5+ years, companies can't find workers. So that means they all of a sudden have to treat workers a whole lot better than workers were treated for the past 40 years. So workers are getting higher starting salary, hourly wages, better retirement plans, health insurance, and flexibility. And I don't think wages are going to come down a whole lot at the end of the day, because how does a company go back and say, listen, inflation came down, we're lowering your wages? I don't think that's going to happen. And that's the one fly in the ointment that the Fed will need to figure out. My personal thoughts is that I think it's a good thing that workers are being paid more. And I'm hoping that the Fed doesn't bring us in for a deep recession. I'm hoping that if we go into a recession, it'll be shallow, short-lived, but we'll see. In hindsight, everything's crystal clear. The one thing I do know is, and Paulo showed a slide, the stock market will recover. The stock market will go back to make new all-time highs. And if history repeats itself, the stock market usually bottoms
on average 10 months before we're in a recession. So when you hear all of this talk about us going into a recession in 2023, that's actually good news in my mind, because that means that maybe the worst is behind us from a stock market correction. And I am in the camp where the glass is half full. I do think that this stock market can turn around, go on, and it will probably be long before we're in a recession, because, as I said, I hope history repeats itself. Hopefully today's webinar brought you some good information. Please, we're going to email it out to you later, and please feel free to share it with friends, family, anybody who you know who may not be happy with their current advisor, or maybe they're investing on their own and maybe they want help. We're here to help. We have 18 professionals, 5 CFPs, 4 CPAs. We're really proud of the value that we bring to the relationship. So let me say that I hope you stay well, be healthy, and thank you for placing your trust in our services. We'll talk to you soon and let you know what next month's webinar is about real soon.